What is an exchange rate? At its core, an exchange rate represents the relative value of two currencies. It's the price at which one currency can be exchanged for another. This price is crucial for facilitating international trade, investment, and capital flows. Types of exchange rate regimes. Floating exchange rate. In this regime, exchange rates are primarily determined by the forces of supply and demand in the foreign exchange market. These forces are influenced by a multitude of factors, which we will discuss later. Fixed exchange rate. Here, a country's central bank or government pegs its currency to another currency, often a major reserve currency like the US dollar, or a basket of currencies. The central bank actively intervenes in the market to maintain this fixed rate. Managed float exchange rate. This is a hybrid system where the exchange rate is predominantly determined by market forces, but the central bank may intervene periodically to moderate excessive volatility or to achieve specific policy objectives. The dynamics of supply and demand. The foreign exchange market is a global, decentralized marketplace where currencies are traded. The interaction of supply and demand for a particular currency determines its exchange rate. Demand for a currency. Demand arises from various sources, including importers who need the currency to purchase goods and services from that country, investors who want to invest in assets denominated in that currency, tourists who need the currency to spend in that country, speculators who anticipate future appreciation of the currency. Supply of a currency. Supply comes from exporters who receive the currency for their goods and services, investors who sell assets denominated in that currency, the central bank, which may increase or decrease the supply of the currency to influence its value. Factors influencing exchange rates. A complex interplay of factors influences the supply and demand for currencies, leading to fluctuations in exchange rates. Macroeconomic factors. Economic growth. Strong economic performance tends to attract foreign investment, increasing demand for a country's currency. Interest rates. Higher interest rates can attract foreign capital, leading to increased demand for the currency. Inflation. High inflation erodes the purchasing power of a currency, potentially leading to its depreciation. Balance of trade. A trade surplus, exports exceeding imports, generally strengthens a currency, while a trade deficit can weaken it. Political factors. Political stability. Political uncertainty or instability can negatively impact investor confidence and lead to capital flight, depreciating the currency. Government policies. Fiscal and monetary policies, as well as trade policies, can significantly influence exchange rates. Market sentiment. Speculation. Expectations about future exchange rate movements can drive speculative trading, leading to volatility. News and events. Geopolitical events, economic data releases, and even market rumors can trigger significant fluctuations in exchange rates. The goodness of an exchange rate. There is no universally good exchange rate. The desirability of a particular exchange rate depends on the perspective of different economic actors. Exporters generally prefer a weaker currency as it makes their goods more competitive in foreign markets. Importers benefit from a stronger currency as it reduces the cost of imported goods. Investors seek stable exchange rates to minimize currency risk when investing in foreign assets. Consumers may benefit from a stronger currency as it lowers the cost of imported goods and services. Conclusion: exchange rates are a critical component of the global financial system. They are influenced by a complex interplay of economic, political, and market factors. Understanding these dynamics is essential for businesses, investors, and policymakers to navigate the challenges and opportunities presented by the ever-changing world of foreign exchange.